People often ask me, Jesse, how can you tell when a move is finished? How do you recognize the ending before the crowd does? And I always smile because that question, simple as it sounds, is the line that separates the winners from the lambs. It isn't about squeezing out every last penny from a run. It's about understanding when to stay in and when to quietly step aside before the floor gives way. In our earlier discussion about identifying breakout trends, we focused on spotting the birth of major moves, but knowing how a move begins is only half the education. Learning when it has exhausted itself is just as important, perhaps even more so. A trader who doesn't know when to exit at the proper time will eventually hand back everything he worked so hard to gain. Ask yourself honestly, how many times have you ridden a stock upward, feeling clever and confident, only to hold on just a little too long and watch your profits evaporate? That sting isn't bad luck. It's a failure to recognize the warning signs. The signals are always present for those who train themselves to see. The market whispers first, then it speaks, and eventually it shouts. By the time the public hears the shouting, the opportunity to protect yourself has already passed. The first element I study is volume. Price movements mean nothing without money supporting them. A strong, living trend breathes through heavy participation. But when prices keep rising while activity shrinks, you're witnessing fatigue. It's like a fighter throwing punches that lack weight. On the surface, it appears the same, but the force is gone. Near the end of many moves, prices may even push to fresh highs. Yet trading volume is thin. That isn't strength, it's exhaustion. The major operators have quietly stepped aside, leaving smaller traders passing shares back and forth among themselves. Then come the sudden, violent reversals. A stock that has climbed smoothly for weeks may drop sharply in a single session on strong volume. The crowd dismisses it as an ordinary correction. But if you've been attentive, you recognize it differently. Trends don't conclude politely, they crack. That first sharp decline is often the opening shot of retreat. How often have you ignored that first break, labeling it noise, only to regret it later? Watch the tape carefully. Instead of the steady upward progression you grew accustomed to, you'll see hesitation, stalling, backing, and filling, aimless motion. The stock appears as though it wants to move but lacks the strength to do so. That tells you the big hands have withdrawn their support. And when professionals remove their capital, you don't want to remain as the last participant at the table. The market has a cruel habit of tempting traders at the very end. Frequently, there will be a final surge, a blow-off top, where prices accelerate dramatically and enthusiasm reaches fever pitch. The crowd rushes in, afraid of being left behind. That is often the trap. The final rally frequently marks the climax. I learned that lesson repeatedly in my early bucket shop days, mistaking the last burst for renewed strength. In reality, it was simply the market drawing in the greedy before collapsing beneath them. This is why discipline outweighs hope. Hope persuades a man to remain in a position even when the evidence contradicts him. Discipline commands him to step aside, secure his gains, and wait. Waiting is the most difficult skill a trader must develop. But it is also the skill that preserves fortunes. Consider the leaders in a bull market. Every sustained advance is driven by a small group of dominant stocks. When those leaders begin to falter, the market is quietly signaling that momentum is fading. Traders who focus only on averages miss this subtlety. Those who observe the generals, the stocks carrying the charge, recognize when the army's strength is diminishing. Would you rather listen to the cheering soldiers or watch the generals quietly leave the battlefield? Psychology is equally vital. At the beginning of a trend, the public doubts and hesitates. That's when professionals accumulate positions. As the move matures, participation grows. By the end, everyone is convinced of endless gains. Taxi drivers offer stock tips, barbers discuss investments enthusiastically. When nearly everyone is bullish, ask yourself, who remains to buy? The loudest excitement usually signals the final act. Remember what we discussed about breakouts. Powerful moves begin when least expected. Likewise, weak endings occur when belief in continuation is strongest. Words from the crowd are meaningless. Observe what the market itself is doing. Trends form habits. A stock may rise, pause briefly, then rise again in a steady rhythm. But near the end, that rhythm deteriorates, consolidations grow longer and weaker. The pace slows. Like a man after a long day, a trend becomes tired. The change in tempo reveals more than headlines ever could. Never underestimate the value of stop losses. Many traders see them only as protection against catastrophe, but they are also tools of discipline. A well-placed stop forces action when weakness appears. Countless fortunes have vanished because someone said just a little longer. It will recover. The stop would have preserved capital, but pride prevented its use. No trader can consistently identify exact tops and bottoms. Attempting to do so is speculation in its purest form. But a disciplined trader can recognize when probabilities have shifted against him. If you exit when exhaustion appears, you may surrender a few final points, but those belong to someone else. The real question is simple. Do you seek pride or profits? Your capital is your army. Each dollar is a soldier. Never send them into a battle that has already turned unfavorable. When the trend ends, withdraw your troops. Preserve strength for the next opportunity, because the market will always provide another chance. Many traders win only to lose everything back, leaving them unprepared when the true opportunity arises. As trends approach their end, volatility increases. Wide swings, erratic moves, false breakouts. Chaos begins to dominate. This is the market's way of telling you that certainty has vanished. Without favorable odds, you have no business committing heavily. Trade only when probabilities clearly support you. Anything else is reckless speculation. Prices do not decline simply because they are high, nor rise because they are low. That logic belongs to amateurs. A trend concludes when the force driving it has been spent, when operators who propelled it are satisfied, and when the public has fully committed. Until then, it may continue beyond imagination. But once those forces shift, nothing can sustain it. The market respects only supply and demand. It ignores personal opinions rather than attempting to predict, observe. Volume thinning, leaders weakening, public enthusiasm peaking, volatility expanding. These are warnings, not coincidences. They are smoke before fire. A wise trader steps aside at the first cent, which is harder, admitting the move is finished or clinging to hope. The former bruises pride. The latter injures the wallet, and pride pays no bills. The essential nature of the market never changes. Faces and company names change, but the game remains identical. Again and again, I have learned that warnings precede reversals. Among the most powerful warnings is a sharp break accompanied by unusually high volume. That is the first visible crack in the wall. A trend, whether rising or falling, survives only because large interests commit substantial capital. When they desire higher prices, they absorb supply steadily. The advance appears smooth and natural. When they decide to take profits, the behavior shifts abruptly. A day arrives where prices decline more severely than at any other point in the trend, and trading volume surges. It appears sudden, but it is deliberate. Professional LS are exiting without hesitation. If you've ever watched a steadily climbing stock suddenly collapse on enormous turnover, you know the shock it produces. Many search for headlines to explain it, but the break itself is the explanation. The selling is genuine and urgent. Traders often misinterpret that first violent drop as a routine correction. But does true strength collapse so dramatically, or does such action signal a weakened foundation? In my early years, I frequently mistook that initial break as an opportunity to buy at a discount. Pride convinced me I was clever. Yet more often than not, the stock failed to regain its former character. Rallies were weaker, and eventually lower prices followed. Experience eventually teaches humility. The market punishes arrogance and rewards respect. A sharp break on heavy volume does not always mean the trend ends immediately. Sometimes a rally follows, but something has changed. Traders who bought near the peak are now trapped, eager to exit at break-even. That overhead supply weighs on every rally. Professionals have already left. Each rebound meets persistent selling pressure. Just as strong breakouts mark beginnings, decisive breaks on heavy selling often signal endings. It is the mirror image of the same principle. Volume remains the ultimate truth. A small decline on light activity is insignificant noise, but a decline accompanied by the heaviest trading, in months, reveals urgency, strong hands rushing for the door. When intelligent capital departs, smaller participants are always late. The choice is simple: leave with the professionals or remain hoping for recovery. Picture the psychology. After months of rising prices and widespread optimism, a single day delivers a sharp collapse on massive turnover. That is not sudden panic from the public. It is deliberate liquidation by professionals. The public reacts afterwards. See profits shrink. By then, the damage is done. That single session can shake confidence profoundly. I have witnessed fortunes vanish because traders dismissed that first warning. They averaged down, convinced of eventual recovery. Small rallies occurred, but conviction was gone. Eventually, another break followed, more severe than the first. The trader, convinced of being right, learned an expensive lesson. Why does it happen? Because a trend, like a man, grows tired. It cannot climb indefinitely. Each upward leg demands fresh strength. When that strength is gone, decline becomes inevitable. It takes fresh fuel, new buyers willing to pay higher prices. In the end, the buyers become exhausted. The professionals understand this, and they sell into the final stages of optimism. That violent break is the moment they withdraw their support from the market. It is like cutting a rope. Without their backing, price collapses under its own weight. You must learn not only to recognize that moment, but to respect it. Do not try to be clever. Do not attempt to outguess it. When you see a sharp break on record volume, treat it as a serious warning. At the very least, reduce your position. Never argue with the tape. The tape is always right. Do you think the tape cares about your opinion, your emotions, or the countless hours you spent analyzing? It does not. It speaks clearly through numbers. It tells you sellers have overpowered buyers. That alone is the information you need. Some traders grow stubborn. They ask, "But Jesse, what if it's a false alarm? What if the stock recovers?" The answer is simple. If it recovers, you can always buy it again. The market will provide another opportunity, but if you hold through the break and it does not recover, you will regret ignoring the warning. Which mistake would you rather make? Missing a small profit or losing a large portion of your capital? Every trader must answer that question. Look at history. The great market tops have always been marked by violent breaks. In 1907, in 1920, in 1920, in 1929, every major collapse was preceded by sudden declines on massive volume. Patterns endure because human nature does not change. The public consistently arrives late. Professionals consistently leave first. The signs are plainly visible to anyone willing to observe them. Also, consider the smaller speculative stocks, the so-called side issues. They often show weakness before the leaders. When speculation runs hot, weak stocks rise alongside strong ones. But when the tide turns, weak stocks fall first. They lack support and committed holders. Watch them carefully. Their sudden breaks can act as the canary in the coal mine for the broader trend. Ask yourself this: do you want to be the trader who hopes, or the one who acts? The one who invents comforting stories? Or the one who respects what the tape reveals? Traders answer that question not with words, but with money. Distribution is a term often mentioned in trading circles, yet rarely examined deeply. To me, distribution is the deliberate and quiet unloading of stock by professionals into the eager hands of the public. It is not speculation or theory. It is observable fact. If you pay attention, and when you see distribution unfolding, you are witnessing one of the clearest signs that a trend is nearing its end. Consider the psychology. A stock has been rising steadily for weeks, perhaps months. Professionals accumulated shares early, long before attention arrived. As price advanced, news became favorable. Brokers recommended it. Small speculators, noticing their neighbors' profits, rushed in. By the time the entire town discussed it enthusiastically, professionals were no longer buying, they were selling. But they cannot unload millions of shares all at once. That would seize the price and erase their profits. Instead, they distribute gradually, selling into strength while maintaining the appearance of health. Do you see the strategy? The public sees strength because rallies look impressive. Yet if you watch closely, rallies no longer carry as far as before. Upward moves meet heavy selling pressure. Volume is large, but progress is limited. That is distribution. Professionals sell into demand, keeping price steady long enough to exit advantageously. How many times have you seen a stock rally, stall near its highs, trade sideways for days or weeks, and then suddenly collapse? It was not random, it was distribution at work. Strong hands transferred shares to weaker ones, and once the transferred shares to weaker ones, and once the transfer was complete, nothing remained to support price. The market then fell under the weight of weaker holders. Distribution does not announce itself loudly. It disguises itself as strength. The tape is active. Headlines are bullish. Brokers are optimistic. Yet the action tells another story. Volume surges on up days, but gains are small. Pullbacks are sharp. Rallies are labored. That imbalance is the signature of distribution. If you rely on opinions and stories, you will miss it. If you rely on the tape, you will see it clearly. One of the greatest mistakes a trader can make is confusing accumulation with distribution. At first glance, they look similar, heavy volume and price moving within a range. But the intention is entirely different. Accumulation follows a decline when strong hands absorb shares from discouraged sellers. Distribution follows an advance when those same strong hands unload shares to excited buyers. The difference becomes clear in the outcome. After accumulation, price breaks upward decisively. After distribution, it breaks downward violently. Which side would you rather be on? In my early career, I watched stocks reach highs and thiff and trade enormous volume without advancing further. At first, I interpreted that as strength. Look at the activity, I thought. But strong stocks do not sit idle and churn. Strong stocks advance. When a stock remains stuck at the top while heavy blocks trade without real progress, that is not strength. It is selling. That lesson cost me dearly. Here is the subtle truth. Distribution keeps you comfortable. Professionals avoid panic while selling. They prefer calm optimism. Newspapers publish bullish reports. Brokers issue glowing forecasts. Small rallies preserve confidence. Meanwhile, professionals steadily feed out shares, like a butcher slicing meat. By the time the public realizes what happened, professionals are gone. Remember the leaders, the generals of every campaign. Watch them closely. When leaders enter distribution, it signals more than weakness in a single stock. It suggests broader distribution across the market. Leaders are where professionals concentrate capital. If they stall, churn, and show heavy volume rallies that fail to progress, distribution is likely underway. That is a warning only a fool ignores. Imagine a stock rising from 50 to 120 over 6 months. Every dip was bought. Every rally was strong. Then, near 115 to 120, behavior changes. The stock rallies sharply on heavy volume, but cannot decisively break to new highs. The next day it falls quickly. Then it rallies again with heavy volume and fails again. Newspapers remain optimistic. Brokers encourage buying the dips, yet you observe something else. Tremendous effort for little reward. That is not demand. It is supply. That is distribution. The public loses because it buys into the very strength professionals use to sell. The crowd sees activity as opportunity. Professionals see activity as an exit plan. Two traders can watch the same action and reach opposite conclusions based on their training. In this business, those conclusions decide who keeps money and who loses it. Distribution phases can last longer than expected. Weeks, even months. Professionals are patient. They allow wide trading ranges, creating the illusion of opportunity. Each rally invites fresh buyers and offers another chance to sell. Gradually, ownership moves from strong hands to weak ones. Once the process is complete, support vanishes, and real decline begins. Do not argue with the tape. If you are long, begin scaling out. You do not need to pick the exact top. Just avoid being the one left holding when professionals finish selling. If you are on the sidelines, remain patient. Do not be tempted by superficial strength. Let distribution finish, then look for opportunity after the decisive break. The market always leaves footprints. Distribution is among the clearest, but it requires humility to interpret. It demands acceptance that public optimism may be engineered, that apparent strength may simply be professionals using you as their exit. Many traders resist this reality. They prefer believing the story and chasing the rally. That preference guarantees a steady supply of new victims in the market. Ask yourself, will you follow stories or follow money? Stories belong to the proud. Money belongs to those who study the tape. Distribution is simply capital moving from strong hands to weak ones. Understand that, and appearances will no longer fool you. The blow-off top is among the most deceptive and dangerous moments in speculation. To the untrained eye, it appears as ultimate strength. Prices accelerate faster than at any other time in the trend. Newspapers shout, brokers celebrate, the public scrambles to buy at any price. But that final explosive rally is not the beginning of wealth. It is the end of the campaign. It is the last lure before the M. Market turns and punishes latecomers. Why does it happen this way? Because human nature does not change. Professionals bought long before excitement appeared. They pushed the stock steadily higher. But unloading millions of shares requires frenzy. A crowd eager to buy. The blow-off top provides that frenzy. It is panic in reverse. Instead of rushing to sell, the crowd rushes to buy, afraid of missing out. Professionals sell aggressively into that demand. Have you ever felt that surge? A stock you follow leaps higher with every tick. Your pulse quickens. You fear being left behind forever. That is blow-off psychology. It feeds on fear, not fear of loss, but fear of missing profit. Ironically, most who chase at that moment end up losing. They buy from professionals who are exiting, and once the final eager buyer is satisfied, the stock collapses under its own weight. In my early years, I fell into this trap repeatedly. I saw runaway strength and believed I had to participate. I often bought near the top, only to be trapped days later. It took years to recognize the pattern. Now, when I see frantic acceleration late in a long trend, I step aside. I let the public enjoy its excitement. I know what comes next. The tape tells the truth to those who pay attention. During a blow-off, volume explodes. Every uptick carries heavy transactions. Gains may look impressive, but they are unstable. Gaps, spikes, erratic bursts instead of steady conviction. The advance resembles a horse exhausting itself in a final sprint. That is not healthy demand. It is desperation. A healthy trend rises steadily, pausing for corrections and consolidation. A blow-off surges forward without rest because it is driven by panic buying rather than disciplined demand. Blow-off tops appear only at the end of extended advances, never at the beginning. After months of climbing, when the public believes the rise will end, that is when taxi drivers, shoeshine boys, and clerks all start buying. Everyone is committed. At that exact moment, the market produces one last spectacular rally to capture the remaining skeptics. Then selling begins. With no new buyers left, prices collapse. I once watched this unfold perfectly. A stock climbed steadily for months in an orderly fashion. Then, within a single week, it rose more than it had in the previous 2 months combined. Newspapers praised it endlessly. People with no prior market experience rushed in to buy. The following week, the stock crashed, wiping out months of gains in just days. The blow-off had served its purpose. Professionals exited. The public was trapped. The decline was merciless. How many times have you seen this? A stock surges wildly. Everyone talks about it. Then just as quickly it falls apart. Notice how it happens at peak excitement. That is no accident. That is the essence of the blow-off top excitement acting as camouflage for professional selling. Unload. If you allow excitement to control your trading decisions, you will always end up as the victim. But if you allow the tape to guide you, you will learn to step aside precisely when excitement reaches its peak. Pay attention as well to the nature of trading during a blow-off. Intraday swings become extreme. You will witness prices jumping 5, 10 points in a single day, sometimes within an hour. Volatility surges dramatically. Yet genuine market strength is never reckless. Real strength is calm, steady, and intentional. Violent swings signal instability. And instability is always a warning. At that stage, the market is no longer controlled by professionals. It has shifted into the hands of the crowd, and the crowd, when left on its own, inevitably loses control. Another important clue lies in the language of the public. At the beginning of a move, the public is skeptical. They hesitate. In the middle phase, they grow optimistic. But during a blow-off, they become absolutely certain. They declare, this stock can never decline. It's a new era. You can't lose. Have you heard that kind of confidence before? That is the death knell. When certainty spreads through the streets, the top is close. The market delights in humbling certainty. And do not overlook the broader trend. A blow-off top in a leading stock frequently signals exhaustion across the entire market. Leaders determine the tone. When a leader experiences a blow-off, it is like the generals abandoning the battlefield. The rest of the army may remain for a time, but its outcome is already decided. Watch carefully for this signal. Do not focus only on the averages. The leaders will reveal the truth first. You might ask, why not attempt to ride the blow-off for a few quick points? Isn't there profit available in those final explosive rallies? Perhaps if you possess perfect timing, but perfect timing belongs to gamblers, not disciplined traders. The risk is enormous. One mistake, one delayed entry, and you are trapped at the exact top. The probabilities are not in your favor. A trader who truly builds wealth is not the one who captures every final dollar. He is the one who recognizes when the easy money has already been made and when dangerous money is being temptingly displayed before him. The blow-off top represents dangerous money, and it destroys more accounts than it enriches. So I repeat, watch for the signals. Sudden, accelerated advances that appear late in a prolonged trend.